Why did the investor go to the beach? Because he wanted to diversify his sands. All jokes aside, let's delve into the world of finance and investment. Today we're exploring a crucial concept: investment diversification. Picture this: you're an investor, and you've got a basket of eggs, or in this case, your hard-earned money. Now, would you put all your eggs in one basket? Probably not. The same logic applies to investments. Diversification is essentially about spreading your investments across various asset classes, sectors, and regions. It's like a safety net, reducing the risk and potentially maximizing your returns. So if one investment doesn't perform well, others might. It's about balance, creating a portfolio resilient enough to weather the storms of market volatility. Remember, putting all your eggs in one basket might result in a disastrous omelette. Just like a well-balanced meal, a well-balanced portfolio is essential for financial health. So, what is diversification? Well, think of it as a way to spread your investments across different asset classes, industries, and geographic regions. It's like choosing a variety of dishes from a buffet instead of piling your plate with just one type of food. Why do we do this? The reason is simple: to minimize the impact of volatility in any one area. For instance, if you put all your money into tech stocks, and the tech industry takes a hit, your portfolio takes a hit too. But if you've spread your investments, a downturn in one sector won't be as damaging to your overall portfolio. In essence, diversification helps you ride the ups and downs of the market by ensuring that your investments are not all tied to the same horse. Diversification is your safety net in the high-wire act of investing. A diversified portfolio is like a financial buffet, with a variety of assets to choose from. Just as you wouldn't fill your plate with only one type of food at a buffet, you shouldn't fill your portfolio with just one type of asset. Let's explore some of the different asset types you might include in a diversified portfolio. First, we have stocks. Owning a piece of a company can offer substantial returns, but also carries a higher level of risk. Bonds, on the other hand, are like lending money to a company or government. They tend to be more stable but offer lower returns. Real estate is another type of asset you might consider, whether it's residential, commercial, or rental properties. Commodities like gold, oil, or grains can also be part of a diversified portfolio. Finally, we have alternative investments. These might include everything from cryptocurrencies to fine art. Each comes with its own unique risks and rewards. Remember, a well-rounded portfolio is as diverse as the United Nations. Diversification isn't just about spreading the risk, it's about reaping the rewards. Let's delve into the benefits of a diversified investment portfolio. First off, diversification lowers volatility. By spreading your investments across a variety of asset classes, you're less likely to experience dramatic swings in value. This steadiness can be particularly comforting during turbulent market periods. Next, diversification can enhance risk-adjusted returns. This means you're not just looking for high returns, but high returns relative to the amount of risk you're taking on. A well-diversified portfolio can help you achieve this balance. Finally, diversification increases your portfolio's resilience to market fluctuations. Here's the thing: no one can predict the future of the market, but by owning a mix of assets, you're better prepared to weather the storm, whatever direction the market winds blow. So remember, diversification is a passport that over the long term can smooth out the bumps on your investment journey. In the world of investing, diversification is your bulletproof vest. Picture this: you're a tightrope walker balancing precariously between profit and loss. Now imagine if you had a safety net beneath you, ready to catch you if you stumble. That's what diversification does for your portfolio. By spreading out your investments across various asset classes, industries, and regions, you mitigate the risk of a heavy fall in any one area. Think of it as not putting all your eggs in one basket. If one basket falls, you'll still have eggs in the others. Diversification also preserves your capital. It's not just about making profits, but also about safeguarding what you already have. It enhances your long-term growth prospects by allowing you to endure market downturns and capitalize on upswings. So diversify your investments and keep the financial Grim Reaper at bay. By managing risk effectively, you're paving your way to a more secure and prosperous financial future. Now that we understand why diversification is important, let's talk strategy. First off, consider asset allocation. This is the process of dividing your investment portfolio among different asset classes. such as stocks, bonds, real estate, and potentially even alternative investments like cryptocurrencies. The goal here is to mitigate risk and enhance potential returns. The ratio of these assets can vary based on your financial goals, risk tolerance, and investment time frame. Next, we have sector rotation. This strategy involves moving your investments from one business sector to another, aiming to capitalize on the economic cycle. The key here is to understand the different phases of the business cycle and how various sectors perform during each phase. For instance, in an early economic recovery, you might want to invest in technology and consumer discretionary sectors. Dollar cost averaging is another strategy to consider. This involves investing a fixed amount of money at regular intervals regardless of the price of the investment. Over time, this strategy can provide a lower average cost per share, mitigating the impact of market volatility. Lastly, let's talk about rebalancing. This is the process of realigning the proportions of your portfolio to maintain your desired level of asset allocation. For instance, if one of your investments has done particularly well and now represents a larger portion of your portfolio than you'd like, you might sell some of it and buy more of other types of investments to get back to your original allocation. These are just a few strategies for diversifying an investment portfolio. The precise mix and strategy will depend on your individual circumstances, financial goals, and risk tolerance. It's also worth noting that diversification isn't a one-time task. It's something that needs to be reviewed and adjusted over time as market conditions, personal circumstances, and financial objectives change. Remember, a good strategy is your roadmap to financial success. Your investment strategy should be as unique as you are. This mantra is the guiding principle when tailoring diversification to individual goals. Just as each of us has unique aspirations and thresholds for risk, our investment strategies should mirror these individual characteristics. Diversification isn't a one-size-fits-all approach. It's a tailored suit, meticulously crafted to fit your financial contours. Your risk tolerance, your investment goals, and your time horizon, these are your measurements. Think of it this way. If you're aiming for long-term growth and can weather market fluctuations, your portfolio might lean heavily towards stocks, known for their high-reward, high-risk nature. On the other hand, if you're nearing retirement and prefer stability, a portfolio rich in bonds could be your perfect fit. Remember, aligning diversification with your specific financial objectives is vital. It's not about following trends, it's about following your path. Your portfolio should reflect your ambitions, your dreams, and your personality. In the game of investing, are you a sprinter or a marathon runner? See, your investment style can often be likened to these two types of athletes. Sprinters, akin to short-term diversification strategists, aim for quick wins. They spread their investments across various assets and sectors with the expectation of immediate returns. They're constantly on the lookout for the next big thing, ready to shift their portfolio at a moment's notice. On the other hand, marathon runners mirror long-term diversification strategies. They're patient, methodical, and steady. They diversify their portfolio across different assets and sectors, but with a focus on the long haul. They're not so much concerned with immediate gains, but rather they're looking to build a robust portfolio that can withstand market fluctuations over time. It's crucial to understand that neither strategy is inherently better than the other. They simply serve different investment goals and timeframes. Whether you're in it for the sprint or the marathon, diversification is key. Keep a close eye on your investments, like a hawk watching its prey. Now that we have a diversified portfolio, it's not just set it and forget it. Regular monitoring is key to maintaining the balance and ensuring it still aligns with your investment objectives and market conditions. Think of your portfolio as a garden. Over time, some investments may grow faster than others, changing the overall mix. This could potentially expose you to more risk or fewer returns than you initially planned for. That's where adjustments come into play. By reviewing your portfolio periodically, you can identify these shifts and rebalance your investments. This might involve selling off some assets that have grown significantly or buying more of those that have underperformed. Remember, diversification isn't a one-time task, but a dynamic process. It's like steering a ship, constantly making small corrections to stay on course. Stay vigilant, stay diversified, and stay successful. Enough theory, let's take a look at some real-world examples. Consider the case of an investor who diversified his portfolio in the late 90s by investing in technology stocks, real estate, and international equities. When the tech bubble burst in 2000, his tech stocks plummeted, but his real estate and international stocks cushioned the blow. Or let's take a look at the story of a retiree in 2008. She had her investments spread across stocks and bonds. When the stock market crashed, her portfolio took a hit, but her bond investments performed well, helping to offset the losses. These are just two examples among countless others that highlight the power of diversification. By spreading investments across different asset classes, sectors, and regions, these investors were able to weather financial storms that would have been devastating had they kept all their eggs in one basket. Remember, the best teacher is experience. We've covered a lot today, but remember, the journey of 1,000 miles begins with a single step. So take that step and join us on this exciting financial journey. Subscribe to our channel, give this video a thumbs up, and hit that notification bell. You'll be the first to know when we drop new content, packed with valuable insights to help you diversify and grow your investment portfolio. Thank you for joining us today. Remember, diversify your portfolio, diversify your life. Until next time.